with a $16 price target. I will also add that the company offers a compelling dividend, providing an attractive total return vehicle. I would also mention that they are off of a very strong second quarter, have really good momentum, and yet the stock hasn't really performed as well as I had expected. So I think it's an attractive entry point here. All of the research on Superior Group of Companies is available on channelcheck.com. With us today are Michael Benstock, the chairman and CEO, and Michael Koempel. He is now the new president and CFO, and he's been promoted to president. So we congratulate Michael. And with that, let me turn it over to Mike. Thank you, Mike.
Thanks, you, Michael, and good afternoon, everyone. We appreciate your time and interest in the Superior Group of Companies, and are very excited to share the highlights of Superior Group of Companies. As Michael said, my name is Mike Koempel. I am president and CFO of SGC, and joining me is Michael Benstock, our chairman and CEO. Michael's family started the business over 100 years ago, and Michael has worked in various positions throughout the business for over 46 years, including 22 years as our CEO. Here's our safe harbor statement, which you can read at your leisure. We believe Superior Group is a compelling investment for several reasons. We have three attractive, diversified businesses which operate in large, profitable growth industries. The industries in which we participate in are highly fragmented, with ample opportunity for organic growth, given our still modest share of the market, which is further enabled by our very strong customer retention across all of our segments. All of our segments have a history of growth and profitability, with our contact center business representing our highest margin and fastest growing business. Lastly, we have a solid balance sheet driven by strong operating cash flow. We've consistently paid dividends since 1977, and we have a share repurchase authorization in place. Here's a quick overview of our revenue growth over the last few years by segment, which, as you can see, resulted in an average annual growth rate of 8%. And you can see across each of our segments, we've again demonstrated growth across all three of our business segments. With that said, I'll now turn it over to Michael to go a little bit deeper into each of our business segments. Michael?
Hey, thanks, Mike, and welcome everybody. Glad you could join us. Give you a little insight to our company. We're one of the largest and oldest providers of healthcare apparel in the country, focusing on consumers as well as healthcare institutions. First, on the consumer portion of the business, we have two very strong brands, Wink, which is an internally developed brand that makes up the largest piece of our revenue. We complement that brand with an exclusive license from Carhartt, which we all know is one of the world's most iconic apparel and accessory brands. Second, on the institutional side of healthcare apparel, servicing healthcare laundries and distributors, we have one of the oldest and most well-known brands in the industry, Fashion Seal Healthcare. This was founded over 100 years ago by my great-grandmother, Rose Benstock. More than 2 million people wear our healthcare apparel to work every single day. With an estimated TAM of over $4 billion, it's clear that although we are one of the top 5 players in the industry, there's still a ton of market share for us to capture. We also have all channels of distribution covered. Our healthcare offering is available via wholesale, through specialty stores, e-tailers, retailers, laundries, and distributors. And starting a couple of years ago, we've taken it a step further to address consumers directly through our direct-to-consumer channel. Our customer list includes some of the most prominent, influential healthcare organizations across various industries. We're proud to collaborate with leaders of the retail sector, as well as esteemed healthcare launders servicing healthcare providers on a truly formidable scale. Let's jump to our second business segment, which is branded products. This segment provides branded merchandise, also known as promotional products, and logoed uniforms to some of the largest companies in the world. We build for our clients gifts that are used for employee and customer incentive programs, uniform programs, conference giveaways, gifts with purchase, branded retail revenue producing merchandise, and pretty much any item in the world that you can think of with a logo on it. Let's look a little bit more into the numbers behind our industry, and most people are surprised to hear that the branded products industry sits at approximately $26 billion in annual revenue. Some interesting facts. Our industry has over 25,000 companies in the US as competitors, small and large, and is highly fragmented. We have climbed from obscurity in 9 years to now being within the top 10 largest branded distributors in the US. We produce tens of millions of branded products per year. Another interesting fact is that over 5 million Americans go to work every day wearing uniforms made by HPI, which is part of this segment. Our company proudly collaborates with some of the largest and most renowned brands across the globe. This is like a walk down Main Street for most of us. We've achieved high customer retention among these companies, which clearly signifies that we consistently deliver exceptional results and exceed their expectations. Next up, Mike will take us through our final segment, the contact center segment. Mike?
Thanks, Michael. Contact centers is our third business, which we operate as the Office Gurus. The Office Gurus is a group of nearshore contact centers supporting both inbound and outbound call services on behalf of a number of brands across a variety of industries. We operate across 3 nearshore countries, El Salvador and Belize and the Dominican Republic, as well as in the state of Florida. By focusing on the small to medium-sized opportunities, we provide our clients with high-touch service as compared to larger engagements with thousands of agents that are largely focused on transactional services. We also bring consistent processes and leverage analytics and technology, all of which are focused on improving customers' experience for our clients. This is another large and growing market, which you can see exceeds over $100 billion in the US alone. And again, as you can see, our market share of the overall market is minimal because, again, we're primarily focusing on onboarding clients that are smaller that often have quickly growing needs. As I mentioned before, this is our fastest growing business with a 5-year growth rate of 22% in sales through 2024 and a very attractive EBITDA margin of 12.6% in 2024 with a strong net revenue retention. Like our other segments, you can see on our slide, our contact center business services a number of brands ranging from established, well-known brands to up-and-coming businesses. Now we'll briefly switch gears for a quick financial overlook. As you can see here, over the last 10 years, Superior Group has grown significantly at an annualized growth rate of 11%. Total SGC revenues in 2024 were $566 million as compared to $196 million in 2014. SGC revenue growth has been driven by all 3 of our business segments, a combination of organic growth combined by strategic acquisitions in both our branded products and healthcare apparel segments. Looking at our capital allocation strategy, it's really focused on 4 priorities. First, we recognize the importance of our dividend as a return to our shareholders, and for that reason, we've consistently paid a dividend since 1977, and at certain points in time have raised the dividend rate. Second, we take advantage of opportunistic share repurchases with our current authorized plan. Third, we continue to make the necessary capital investments in our business to support growth, typically in the range of 1 to 1.5% of revenues. And lastly, enabled by our strong financial position, in a disciplined manner, we will consider strategic acquisitions that are highly accretive and complementary to our existing businesses. That concludes our presentation. I do want to note that you can find an expanded investor presentation on our website for additional information on our 3 business segments. With that, I'll turn it over to you, Michael, for any questions that you might have.
Thank you, Mike, and obviously a very compelling presentation. I just wanted to kind of follow up on a couple of questions here. Obviously, you're in 3 attractive businesses, and I was wondering if you can just kind of give us a sense of the macro environment and how that has shaped demand over the past year, and what type of conditions you would typically need to see each of those businesses start to really hit their groove, particularly, in the light of the fact that we're starting to see, some Fed rate action on the lowering rates and so forth. If you can kind of give us a sense of what you're seeing.
Yeah, I'll take that. each of the businesses is different, and even our customer base is so diversified that you see differences between the different types of customers that we have. But overall, start with our largest segment, our branded product segment. Post-election, even maybe a month or so before the election, we saw things starting to slow down. A lot of uncertainty about what was going to happen politically. A lot of eyes were on the election and not focused necessarily on purchasing gifts and for employees and for customers. And that we expected once the election was over that would abate. And everybody take themselves off a pause and start buying again. We know they had the budgets to do it, but we didn't see the kind of activity that we expected right away. And there was a lot of talk about tariffs and a lot of talk about uncertainty. And up through probably the beginning of April, which we all know what happened then. Things were pretty slow. Things started getting back on track after that. And have since on track. We came out of second quarter looking pretty good. And really, there was I think a sort of pent-up demand that we're able to benefit by. But also, I think a lot of people pulled some of the purchases forward into second quarter because they were concerned about the tariffs. So it's been this up and down, and if you'd asked me a couple weeks ago about tariffs, I would have said, oh well, I think we're done with that noise, and we had situated ourselves with our diversified manufacturing base everywhere that it really wasn't going to impact very much. We were able to raise prices in most instances, but there's been noise. We thought we were done with tariffs, but there's been some noise in the last couple of weeks, particularly that hit the furniture industry and hit the heavy truck manufacturing, even when we thought everything was done. So who knows what our administration is going to do next? I think we're pretty well protected. I think we're in holiday season. We're coming up soon, and employees will get holiday gifts. I think everybody, if we could see in the macro environment, an interest rate cut this year, some visibility to there being some cuts next year, things really, I think, would heat up for that business and help us greatly. I'm not disappointed with how we did in second quarter. I think, Mike, correct me if I'm wrong, we're up 14% in revenue. So,
Yeah.
That's a nice jump. Sometimes we're comparing ourselves in a prior year against a rollout that happened, but in second quarter, we weren't. So it was a good quarter for us. In the healthcare uniform business, that business is steady. I don't think that the market has slowed down purchasing necessarily. I think nurses still need uniforms. They're still taking a portion of their paychecks and buying uniforms. And that's on the digital side, on the direct consumer side, or when we're selling through Amazon or other people. On the institutional side, which is a very cautious side of that business, when I say the institutional side, these are the laundries that we're selling to, the Cintas and the UniFirst, and the different distributors that are out there. They're acting more cautiously. They're acting more cautiously with their spend, with their capital spend, as well as resupplying themselves with uniforms. There's been some consolidation within healthcare. Ultimately, that will be helpful, but while that's going on, that creates a certain amount of uncertainty around how much they should be buying at any given time of the particular uniforms, or renting from the laundries at the particular time. But if you look overall at the reports that have been produced for the institutional laundry market, you'll see that the market looks very healthy. So we're feeling good about that in the future as well. And the call center business, there's a huge demand for nearshore call center services. Our pipelines are as full as they've ever been. We have more business at the end stage of a pipeline than we've ever had. Business just waiting to close when people get some certainty around what's going to happen. But we are putting on new accounts at a pretty good rate, and are seeing visibility to getting back to higher growth in that business in the near future. We've said it before, we are looking for an offshore presence. Right now we're nearshore, primarily. We're looking for a lower cost offshore situation for ourselves, preferably an acquisition. And we feel like once we've done that, we'll be able to springboard our sales to even greater levels. But all the businesses are healthy right now, and they're all operating in this crazy macro environment. But it's been a couple of years of a crazy macro environment, and it'd be nice not to have any noise out there for a while when we get back to worrying about our day-to-day business.
Right. Thanks, Michael, for that color. Obviously, it sounds like you have still some favorable momentum, with you. I was just wondering if you could just talk a little bit, following up on those comments about the customer sentiment and how that's trending, especially for your branded products business. Is there more certainty today compared to the beginning of 2025? And do you think that tariffs are still causing some customers to rethink purchasing decisions right now?
It very well could be. I think it's better, but I do think that there are people who are still worried about where we are politically, where we are economically, where we are in the whole, on the world stage, that are just and that impacts their business in some way. And so, they pulled some levers back on purchasing. So I think there's still some out there. Like it's not what it was in February and March, for sure. But I still think there's some uncertainty. Look, even I said to an investor earlier today, even we're being very intentional in our spend, and obviously to produce a good result for our shareholders, but more intentional even than normal. And I think everybody is being a little bit more intentional. And so, it will eventually open up. And when it does, when we get back to a normalized economy, and you'll see, a lot of spending on customers, because, you still got to spend to keep them and your loyal customers. And you'll see more spending on the employee side too when the labor market heats up and there's more turnover, which right now we believe turnover is very, very low in businesses. I mean, that's what we've seen in all the reports, Department of Labor, although they didn't come out this month with a report for obviously reasons. We see the ADP reports and some other reports that guide us that way.
Gotcha. And I know that AI is all the buzz, is the potential disruptor and so forth. How is the use of AI, especially in your contact center business, serving to differentiate the company versus the competition? And is it a real selling point when signing up new customers, or is AI more about enhancing your own internal efficiencies?
It's been both for us. I mean, we're excited about AI. We were early adopters, and we put together an AI team in, I don't know, 5 years ago in all of our businesses, who actually work with each other, by the way, because some things are applicable from one business to another. And we were early adopters, and I'm telling the story backwards how I usually tell it, but we've deployed AI to over 35 accounts right now, and AI sits on every conversation. What does AI do? AI listens to the conversation, coaches the agent when it hears sentiment that it feels like the agent's not getting. Will tell the agent what they can say to change that sentiment. It listens to the entire call and scores it as it's being done, and at the end of the call gives the agent feedback as to what he she could have done differently. And then the person, it wraps it all up for them. At the end of the day, they have a score. But the old way of doing that was that you had one person who listened to 5% of the calls for an account and manually scored, had to listen to the call and manually scored. And so obviously, from a back office standpoint, we've been able to reduce headcount greatly. Now, being that we've successfully put AI into 35 different accounts, by the way, we also have accent smoothing and translation technology, all kinds of stuff. And that technology is just getting so good. And what we're seeing is it's helping our agents' interaction with our customer's customer. And they're getting higher scores, they're getting better reviews, they're getting more sales as a result. So our customers are the beneficiary of this so far. We in some cases we charge for it. In some cases it's just a cost of doing business. But we feel like we're very competent. We're competent to the point where one of the two actually of the AI companies that we've worked with, who we use their technology, and we're the only ones in the BPO world using their technologies, want us to be an installer of their technology for non-BPO businesses, because obviously we wouldn't help our competition with this. That will be a new line of business for us going forward. But we put together a really competent team, and that's the thing we hear about AI in even the largest companies. They tell us and task us, Teleperform, that they're struggling with it because they have so many different levels of approval that they have to go through, and it's just we're a lean machine, and we just get stuff done, and we get it done right by really smart people.
Well, it sounds like you're developing very skilled employees, that's for sure.
It's wonderful. It's
Yeah.
been a great aid for us, and our customers love it.
Yeah. And Mike, I was wanting to bring you in the conversation. Can you bring us up to date on the balance sheet? Obviously, you have a pretty strong balance sheet there. You've accomplished a lot during your time as CFO, and I was just wondering if you can give us your thoughts on the proper leverage ratio and what your top priorities are for deploying cash over the next year.
Sure. As we said before, we want to operate the business in a leverage ratio in the range of 2 to 2.5 times EBITDA. And now recognizing there can be some cyclical earnings to our year, or perhaps an investment from time to time that could go below or temporarily above that range. But that's really what I would call the sweet spot of where we want to operate the business. We feel like that gives us the flexibility to do things such as share buybacks, or when we feel that's opportunistic. It also helps us, weather challenging times. I think one of the advantages we had earlier this year, despite the headwinds of tariff, I believe our financial position was a competitive advantage relative to our competition. So we feel that's really important to maintain. So, it really starts there, Mike, with having, a strong net leverage ratio. And then it really goes back to the capital allocation priorities I just outlined earlier in the presentation. Of course, we want to support the dividend, and we want to invest as needed organically in the business. But also, as Michael mentioned, with our contact center segment, we also want to look for strategic acquisitions that could really be step function changes in our branded products and in contact center segments that can really help spur growth. And so I think having a good financial position and keeping our eyes on the balance sheet enables us with those opportunities and to have the right amount of flexibility.
Yeah, and I know that the company's been really good about returning capital to shareholders and stock buybacks and dividends. I was just wondering if you can remind us where you are in your stock repurchase and what you have remaining on your stock repurchase.
Sure. We currently have an approval plan from the board of up to $17.5 million. This year we spent about $7 million in total. That was a combination of completing our prior plan and spending within our existing plan. So we have plenty of capacity remaining in our $17.5 million approval. We remain active in the market, and again, we will buy from time to time based on a number of factors that we're constantly looking at. And again, being mindful of other needs within the business, and again, our desire to maintain an appropriate leverage position for the company.
Yes, and in current levels, the dividend yields about annualized dividend yields about 6%. So it's pretty
Correct.
compelling. I know that you've been asked this before, but how do you think strategically about the businesses you're in? And I know that I think it's really important for investors to kind of unpack this company, because it might seem complex to a few, but if you really unpack this company, there's just a lot of opportunities here to really grow this business. And I was just wondering, as you look at this company, and there's not a lot of synergies, although the diversification is really a nice benefit. Are you open to shedding segments if the price was right? And on the flip side, might you ever look to grow the company further via acquisition? What specific areas would you like to grow?
Oh, there you go. Well, I think Mike said, area growth, we're really think has the most opportunities in our branded products business. With 25,000 competitors, it's for sure, it's more than half of our business today, and it's the portion that has a market cap that really or a market that really is exciting to us, and we think we're very good in that market as well. We think we're one of the best players in that market. We can be bigger. Uh, so from an acquisition standpoint, that's attractive. On the call center side, what could be attractive to us is getting us into a new line of business or into a new geography, a less expensive geography. So it might be South Africa, it might be the Philippines, it could be a number of places. It could be we're not big on the medical side of or the financial services side of doing call center work. But if we were able to find somebody and that was their expertise and they were in the right geography, and of course there's a whole bunch of other criteria they would have to meet, we would be excited about it. As far as shedding businesses, we've done it in the past. So, and it's been a while. I think the last time we shed a business was 2008, just in time for a recession. So timing's everything. But timing on shedding a business is everything. It's when are valuations best? When are people going to be able to borrow correctly to have it make sense to them to buy it? When are we going to get the best bang for our buck? And when will that, when will it be large enough that it will make a huge difference to the rest of our business or to our shareholders with the capital that we receive from that? Mike, you want to answer? Did I miss anything there?
No, you got it covered.
Okay.
Well, I want to talk a little bit, the last question I think we have time for here, talk a little bit about margins. The second quarter was actually a lot better in margins than I would have expected, especially, we talked a little bit about tariffs, and I know you're probably tired of talking about that. But I was really surprised at how well you mitigated the tariffs. And given the success of taking cost out of the business over the past year, I was wondering how you think about margin potential in each of your businesses, and to say that, just kind of looking at it from the perspective of, do you think that each one of those businesses has the opportunity to improve margins, kind of going forward?
The short answer is yes. As you referenced earlier in the year, we did execute some cost reductions, and quite frankly, as any business evolves, things that perhaps were important before aren't as important. And so I think that was helpful for us to eliminate cost that isn't maybe as relevant as it used to be, or driving the business. Where at the same time, I think, as we've talked before, we've made investments in really increasing our selling capability, where we think there's really the opportunity to drive sales. So I think between taking some cost out of the business, also making some investments in the selling capability that we think will enable us to grow the top line, the combination of those really across all three segments, because everything that I just mentioned applies to all three of our segments, I think gives us the opportunity for margin growth as we move forward.
That's great. I think that's all we have time for. I want to thank you for participating in the conference, and I really encourage the investors on the call today to take a look at this company. It may seem a little complex, but really, once you unpack the story here, I think each one of their businesses has a very compelling growth opportunity. We just heard that each one of those business segments has improved margin opportunity, and I think it has a very compelling total return opportunity, given the very compelling annualized dividend yield. So get to know this company and take a look at our research reports. And again, you can find that on channelcheck.com. Thank you.
Thank you.
Thank you.
But are you seeing the presentation?
Yes.
So you see the lady with the glasses in the investor presentation?
Yes.
Okay. So